Money FM 89.3. Best of breakfast. The bigger picture, only on Money FM 89.3.
Good morning. Welcome to the bigger picture. Me, Ryan Huang. And we are zooming in how Asian fixed income is doing. It seems like they're outperforming, but just looking at recent data points, it is painting a very interesting picture. Various data points are showing that factory activity in many parts of Asia are shrinking as U.S. tariffs take a heavy toll, highlighting the darkening outlook for the region. We have U.S. President Donald Trump's flip-flopping on trade tariffs, leaving firms unsure about where things are going and how they should be budgeting or hiring. So places like trade-reliant Japan and South Korea continue to see manufacturing activity contract in May as Trump's automobile tariffs cloud the outlook for exports. So that's the story for many other Asian economies as well. So where does this put Asia fixed income in the coming months? Let's check in now with Ang Zhe. He is the fixed income portfolio manager for Allianz Global Investors. Zhe, good morning. How are you doing these days?
Hi, good morning, Ryan. Thanks so much for having me here.
Yeah, I suppose it's a very tricky time to paint or project where things are going with all the back and forth with tariffs and the uncertainty out there. What's your assessment right now, how the Asian picture is?
Yeah, I think so far this year, the strong performance of Asian fixed income really comes down to two main drivers: the appreciation of Asian currencies and the resilience of the Asian credit markets. So let's start with the local currency bonds. And what really stood out was how Asian currencies have strengthened against the US dollar this year. We saw the dollar weakening at the start of the year, but things began to shift in late April when the Taiwan dollar appreciated quite sharply. And that was a key turning point because after that move, we saw other Asian currencies, especially those of net creditor economies, start to follow. And investors began pricing in a second and sharper leg of currency appreciation. And a big part of that was the view that net creditor Asian economies would increase FX hedging against the dollar, therefore supporting their domestic currencies. And the FX policy might now be brought into US tariff negotiations. And that raised expectations that these currencies could continue to strengthen against the dollar. And now what's interesting is that with all the volatility in US treasuries, Asian local currency bonds have held up well. Since Trump's re-election, the beta between US treasuries and Asian bonds has weakened, and with the inflation still relatively contained across Asia amid slowing economic growth, as you rightly pointed out, central banks in the regions would be keen to ease monetary policy. And earlier this year, some of them were a bit more cautious because they did not want to trigger any capital outflows from policy rate cuts. But now with the US dollar on a softer note, they've become more comfortable cutting policy rates, and that's helped local currency bond markets perform.
Okay, so it seems like investors are moving towards Asia in some sense because of what's playing out in the US, the de-dollarization trend, and that, of course, I suppose sparked to some extent by the downgrading from Moody's from AAA to AA1. So there have been some concerns around the US deficit, and we've seen investors sell US assets and investing elsewhere. So what is the elsewhere? How much is this going to continue to go on for?
I think it's still early days. This is really a very structural theme that we are looking into, but we do think that the building blocks are in place. As you rightly pointed out, when we look at the outperformance of the local currency bonds, one of the bigger themes starting to come through is the risk of de-dollarization. We do see some investors starting to consider other currencies like euro, Australian dollar. And to be clear, I think we need to know that this is really a long-term shift, given how US dollar has been so entrenched in the global financial system. I think that has been a key driver for local currency bond markets. And to put this into perspective, if you look back at how Asian economies have evolved since the Asian financial crisis, the shift has been massive. These economies have run consistent current account surpluses for years. And as a result, Asia today holds the largest international investment position globally at around $45 trillion. And about 41% of portfolio investments is parked in US assets. So now when we think about US dollar threatening to weaken in a structurally meaningful way, it forces a rethink, and investors will start to assess the FX risk and whether to consider whether to continue recycling asset savings back into US assets. But granted, now there are not many alternatives that are of similar size for investors. So in the short term, investors will be looking to hedge the FX risk rather to shift the investment allocations outright. Okay. And this is where, we think the Asian currencies will come to focus. So many of them have been undervalued for years, and we see some inflows into Asian local currency bonds in recent years, but we do believe there's plenty of room for more.
All right, let's take a look at where things are for Asia. You painted a pretty good picture. So when you look at Asia, where are the markets that you are focusing on in terms of attractive opportunities? How do you decide where to go into?
Yeah, I think going along this theme, we do focus on the economies with the surplus in terms of the gross international investment positions to think about if this theme were to play out, what are the flows impact? And then we also look at the valuation of the currencies. Like, for example, some of the more export-oriented economies which have shifted the growth model since the Asian financial crisis to run current account surpluses through undervalued currencies. I think these trends will start to reverse. Instead of making excess savings and then replowing them back into the US assets, they could be looking to gradually and sustain revaluing their currency stronger and also look to park their money elsewhere in other markets and especially in Asia, because Asia, eventually we do see the continued integration of the economic and financial ties across the countries, which will continue to underpin the strong economic growth momentum for this region.
Okay, how much is it going to be a concern when you have some of these export-dependent or orientated economies seeing a stronger currency? Would that be making their exports less competitive?
Yeah, I think that is a part that I think these economies will have to deal with, because as the Korean Minister of Finance have also admitted that there were discussions of FX policy with the US during the trade tariff negotiations. So that is something which will become a bigger deal when they negotiate with the US. So I think for these economies, they would have to look at the whole package as a more holistic manner. And at the same time, these exports have also, at least for these North Asian economies, the exports are of higher value add, whereby the sensitivity to FX may be less compared to the lower value add exports like, textiles, shoes.
All right, just to wrap things up, Zhe, what are some reasons why investors should be looking at Asian credit more closely as we round up the rest of the second half of the year?
Yeah, I think Asian credit is also something that we are still quite positive on, other than Asian local currency bonds. I think three key reasons we believe why it can outperform will be diversification, limited exposure to US tariffs, and solid credit fundamentals. So I think we have spoken quite a bit on diversification. I think in Asia, the investment grade credit market actually has a higher average rating than the US counterpart and also when you consider the US credit rating downgrade, investors are now looking for high quality alternatives. Secondly, the tariff story. I think you really laid the ground very well at the start of this chat about how Asia seems to bear the brunt of US tariff policy. But if you look at the actual credit universe of Asia credit, the exposure is actually quite limited. So take for China, for example, in this universe, most of the issuers in this space are large financials and government-linked entities with strong onshore funding supporting them. Other countries like Asia, Southeast Asia, Australia, they are largely domestic-focused issuers. And now when we look at North Asia, we see more exposure to global trade. But key sectors like semiconductors have also been carved out of the tariff regime. And these companies typically have strong balance sheets and predictable cash flows. So I think it's really important to separate the equity market narrative from what is actually happening in Asian credit due to the different composition of the universe. And lastly, fundamentals. I think Asian issuers across the board are coming into this uncertain period in good shape. Credit metrics are either stable or improving. In investment grade, we have seen more upgrades than downgrades over the last year and for this year as well. And in high yield, this trend has also started to turn around with more upgrades coming through in recent months. So default risk has also been quite contained, and most of the credit universe is sitting in what we call the sweet spot of the credit cycle framework. So when you put all of that together, low exposure to tariff shocks, strong fundamentals, a region that is structurally improving, we think Asian credit has a solid case to keep outperforming, especially if there are any sell-off due to market volatility. We think that will be a good entry point for investors to invest and lock in high quality, durable portfolio income for their portfolios.
All right, great overview of where Asian fixed income is going for the rest of the year. And we've been in conversation with Zhe. He's the fixed income portfolio manager for Allianz Global Investors. Zhe, thanks for your time this morning.
Thank you so much.
All right, catch up again soon. Stay Money FM 89.3.
Before acting on the information on Money FM, please consider if it's suitable for your own investment objectives, financial situation, and risk tolerance. To listen to more great interviews, download our podcasts at audio.sg or download the audio app. That's AWEDIO, audio at the App Store and Google Play.